Hi, good afternoon. I'm Will Beamer, President and Chief Investment Officer at Dowling Yahnke Wealth Advisors. On behalf of all of us at DNY, we're so glad you've joined what promises to be a lively and informative 90-minute roundup of the current state of the economy and the financial markets. A little bit about our firm. Dowling Yahnke was founded in 1991 and is celebrating our 30th anniversary this year. Since day one, we've been fiduciaries, putting our clients first. Today, our team of 55 people manages about $5.7 billion of assets and provides discretionary portfolio management and financial planning services to more than 1,300 clients in San Diego and across the country. We work hard to earn your business every day and remain humbled by the trust you have placed in us. Thank you. As many of you know, DNY has partnered with Charles Schwab since the very beginning. We are very fortunate to have two of Schwab's very best, Kathy Jones and Liz Ann Sonders, with us today. Kathy Jones heads up the Fixed Income and Currency Strategy Group at the Schwab Center for Financial Research, where she is responsible for Schwab's point of view on the markets and investor education. Jones has covered global bond, foreign currency, and commodity markets extensively throughout her career as an investment analyst and strategist, working with both institutional and retail clients. She makes regular broadcast appearances on CNBC, Bloomberg TV, Yahoo Finance, and NPR. Liz Ann Sonders is Chief Investment Strategist at Charles Schwab. She has a range of investment strategy responsibilities ranging from market and economic analysis to investor education, all focused on the individual investor. Liz Ann has been named one of Smart Money's Power 30, their list of the most influential people on Wall Street, the Best Strategist of the Year by Kiplinger's, one of the 25 most powerful women in finance by American Banker, US Banker, and one of the top 50 top women in wealth by Wealth Manager Advisor One, to name a few honors. I also happen to know that Liz Ann is a passionate rock and roll fan and has been known to weave references to Led Zeppelin, the Rolling Stones, and U2 into her market commentaries. Maybe we'll get a little taste of that today. No pressure, Liz Ann. For the next hour, I'll have a wide-ranging conversation with Liz Ann and Kathy. Our rough agenda is to cover the state of the economy and the stock market, the heightened level of inflation we're all experiencing, the Federal Reserve and monetary policy, and several portfolio concerns that are currently top of mind for investors. Thank you for submitting questions in advance. You can also ask questions during the discussion with the Q&A button at the bottom of your screen. We'll tackle as many as possible during the 20-minute Q&A at the end of the webinar. Let's get started. So Liz Ann, I'm going to start with a few questions for you. While we were all enjoying Thanksgiving turkey last week with friends and family, we incorporated a new Greek letter into our everyday vocabulary, Omicron. This new COVID-19 variant was discovered in South Africa and concerned scientists and policymakers because of its many mutations and its potential to skirt the immunity conferred by currently available vaccines. Last Friday saw a worldwide sell-off in stocks down to 2 or 3% and a significant spike in volatility. The market has stabilized somewhat this week, but volatility remains elevated. How concerned should investors be?
So it's the great question of the day, especially on a day where just this afternoon we got news of the first known case in the United States in San Francisco. So I think that added to some concerns, but there's just not enough information that we have at hand in terms of how serious it's going to be in terms of who it's infected. Does it start to put stress on the healthcare system? What is the global reaction going to be? Notwithstanding the unlikelihood that the US goes into any kind of federally mandated lockdown situation, that doesn't mean there won't continue to be travel restrictions. If it makes its way to mainland China, do they continue with their zero COVID stance? That has implications, obviously, for global growth, but also as it relates to global supply chains and the disruptions there, because China is very much at the center of a lot of that. So there are still more questions than there are answers. I think with regard to the reaction on Friday, first of all, I think there are always myriad things going on at any point in time that explain what the market does on any given day. And clearly that was seen as a negative. But I think leading into that negative news that we got on Friday was a very frothy sentiment environment that was accompanied by deteriorating market breadth. And that double whammy tends to be the setup for a greater amount of weakness or more volatility to the extent you get some sort of catalyst that suggests a tail risk. So I think it was as much the setup leading into Friday as it was the news on Friday that led to that weakness and what has been a pretty choppy few days since then.
Yeah, I think that's spot on, and I really empathize with the take that it's always hard to pinpoint what what affected the market, and the media always wants to pinpoint one thing that that causes the market to go up or down. Maybe we'll back up for a second and get your thoughts on the overall economic environment, even in the absence of Omicron. We've seen significant economic growth since the COVID shutdown 21 months ago. But more recently, supply chain bottlenecks, high energy prices, and businesses' inability to find workers have constrained output. What's your outlook for the economy in 2022? What do you think? Do you think some of these pressures start to ease? And what data points and trends are you most focused on right now?
So at this point, the health of the economy looks to be able to be sustained, notwithstanding the unanswered questions associated with whether it's the Omicron variant specifically or just broader virus trends. And it's not just the variant and the health aspects to it. Of course, the impact on the economy is more about what restrictions are put in place. And I'm not just talking about restrictions put in place by officials, but as human beings, we make decisions. We might restrict our own activity based on concerns and fears. And that actually feeds into the labor supply problem, because one of the key answers given when those who have dropped out of the labor force are asked what the rationale is, it is directly or indirectly related to the virus and health concerns, either about themselves or driven by the type of employment they might have had, or in some cases, concerns about the health of family members as well. So much as we all would have hoped that that was in the rearview mirror after almost 2 years, it is not. So we're still somewhat at the mercy there. I think in the third quarter, where we saw weaker growth, not only relative to what was expected in terms of GDP, but certainly down from the much stronger growth in the second quarter, I think that was somewhat due to the constraints associated with the Delta variant, but also just the weight down on economic activity by virtue of the supply chain disruptions and high inflation. So I think as we head into 2022 in terms of the outlook ex virus trends, the question is, do we stay in what for the most part has been this pro-cyclical inflation environment where surging demand is what led to, in large part, the increase in prices, or does it shift to counter-cyclical style inflation where high prices start to put downward pressure on demand and on overall economic activity? Most of the data broadly on the economy has been fairly positive. There are certain things that I think we need to watch for. We had started to see a convergence in terms of consumption for goods versus services. The Omicron variant could disrupt that, obviously, if there's constraint on access to services. Buying intentions, which are subcomponents of both consumer confidence and consumer sentiment, have plunged for big ticket items like homes, vehicles, as well as large household goods. And also within consumer confidence, the expectations component has been, for the most part, deteriorating more than the present situation component. And that is something worth watching as we head into 2022. So we know there's a high stock of consumer savings. That has been a very strong pillar of support for the overall economy. What we don't know is whether we can assume all of that gets funneled into the economy via demand, or whether for virus or inflation or other reasons, you see a bit of a pullback in consumption as we digest the impact of not only this inflation environment, but also what the kind of next news is with regard to this variant.
So as you and your team think about, obviously there's kind of what's happening right now in the economy and what does next year look like, maybe open the aperture a little bit in terms of lasting changes from the pandemic. I mean, I think one that we're all very aware of is that, workers have grown pretty accustomed to, not having to come into the office and being able to work remotely, maybe not just from home, but from anywhere. Are there other trends that you and your team are looking at that you think will really kind of transform the corporate landscape?
Yeah, and I agree with you. And I think that the genie is out of the bottle and not going back in terms of greater workplace flexibility, which will vary from industry to industry, job to job. But I don't think we're ever going fully back to where we were. I think what was also highlighted through the pandemic was companies' need to adopt to the use of digital technologies, not just for the purposes of being able to do meetings like this, but for efficiency and productivity purposes. And even before the pandemic, we did have decent capital spending, but it was largely concentrated in technology-oriented areas. And that was really proven to be the key difference between the types of companies that fared well during the pandemic and those that didn't. And I think thinking beyond just the near term, thinking longer term, I think what this has the potential to usher in, even in the face of consumer spending being now more than 70% of GDP, is that we may be heading more toward an investment-driven economy than a discretionary consumption-driven economy. Not overnight, but you think about what the pandemic did to sort of force a rethink on the part of whether it's healthcare or education about the need to make investments in efficiency and productivity and everything digital. And in some cases, it really sped up the need to focus attention on those investments. And so I think longer term, a shift toward a little bit more of an investment-driven economy and a little bit less of a discretionary consumption-driven economy would actually be a longer-term positive for the U.S. economy.
Next question. I want to turn our attention to Washington briefly. Obviously, there's been a lot of talk, and it's still a little hard to know exactly what we're going to end up getting out of the social spending plan and what the tax provisions will be. But we did get an infrastructure bill passed fairly recently, and I'd love to hear from both of you on this question. How do you see the passage of the infrastructure bill, the likely enactment of some sort of social spending plan to the tune of another $1.5 to $2 trillion? How do you see that impacting the economy and the markets in 2022?
Well, there was clearly a lot of bipartisan support and a lot of public support for the infrastructure package. I think the questions now that we'll attempt to get answered is, how shovel ready are they? Are they going to face labor shortages, much like the rest of the economy is, as they try to actually implement this more broadly? Does it ease inflation pressures? Of course, the biggest proponents of the bill suggest no, but we don't know the answer to that, whether it actually has the possibility of causing a deterioration in those supply chain problems before it might eventually help. What we do know is it doesn't represent fiscal stimulus to the same degree that the $5 trillion spread across 3 bills represented coming out of the early stages of the pandemic, which was direct relief right into the hands of households and businesses. This is spread out over a much more lengthy period of time and doesn't represent that direct stimulus. So you add that to the mix of tighter monetary policy, and it's just definitely a different backdrop. I think it's too soon to say on the Build Back Better, other than maybe what's important is what we know we're likely not going to see in it, which is major tax increases across the board, resembling what the first proposal associated with the social spending bill looked like. So I think that is something certainly that many businesses and individuals have been breathing a sigh of relief about.
Kathy, anything to add?
I would agree with Liz Ann that there's a very big difference between the infrastructure bill and the kind of fiscal stimulus that we saw during the pandemic. It is spread out over 10 years. Presumably, if you invest in infrastructure, you lift productivity, which is good for economic growth and good for, the kind of real growth beyond inflationary growth. So net, it should be positive on the Build Back Better. Our Washington folks are just saying, we don't know what's going to make it through and what isn't going to make it through. It's hard to really invest based on that.
Well, I know I've been pretty amazed when you had what was taken as a given, 3 or 4 months ago, that, it was absolute slam dunk that the top marginal rate was going to go from 37 to 39.6, and now that's off the table completely. So it's been quite a reversal. So and like I think you both said, I think it has been a big sigh of relief for a lot of people. Liz Ann, I'm going to come back to you, and I'm sure this is one of your very favorite questions. It's been a long time since we've had kind of at least a market-wide correction. I took a look yesterday just at the Russell 3000 market index, and obviously we had a major sell-off in March of 2020 when the shutdown went into effect. Had a V-type recovery, a V-shaped recovery from that. And since that recovery, probably the biggest drawdown we've seen is maybe in the neighborhood of 7 to 8%. Is there complacency in the market? Are we due for a major sell-off? And what, if anything, should investors be doing to prepare for that?
Well, I do think there is complacency in the market. I think at times, beginning of this year, even recently, as I mentioned, heading into Friday's initial weakness driven by COVID and Omicron, is we have seen pockets of speculative froth. But to this notion that the market has been incredibly resilient given very limited drawdowns at the index level, that suggests that you're not looking kind of one layer deep, peeling the onion one layer back. So using the standard benchmark index more than, less than the overall Russell 3000. If you look at the S&P 500, 93% of the components, that's 465 stocks, have had at least a 10% correction at some point this year from a high. And the average drawdown, maximum drawdown at whatever point this year it happened across all 500 stocks, even including the 35 that had a drawdown less than 10% at some point this year, that's minus 19%. That's almost bear market territory. It's even more jaw-dropping for the NASDAQ. It's a slightly lower percent. 89% of the NASDAQ has had at least a 10% drawdown at some point this year. But the average drawdown across all stocks in the NASDAQ is 41%. That's deep bear market territory. It's just the nature of rotational corrections is when you get these pockets of weakness, and it's varied as to what the drivers of weakness are. Some of it has been driven by the move in yields, by inflation, by the Delta variant, by other economic news that puts maybe cyclicals in a better light than defensives, or growth versus value, or large versus small. So there have been different bases for these rotations, but the nature of rotational corrections is wherever you're finding significant pockets of weakness, there's offsetting pockets of strength. So the net is that the index level drawdowns have been quite mild, but what's happening under the surface is, quite frankly, much more reflective of the ongoing risk. Now, whether that type of rotational correction continues, I think it could, but we have to be mindful of the risk that at some point we get an index level correction again, that the indexes maybe play a little catch down to overall rotation. But rotational correction could continue. It's I think a more enjoyable way to go through a corrective phase than the bottom falling out all at once. So I would certainly vote for that persisting as opposed to the bottom falling out at once. But we are going to get a 10% correction in an index like the S&P. There's no question about it. I don't know when, nor does anybody else.
Some of those numbers are pretty astounding around what's happened to the individual components of the index. I'm kind of curious, at the risk of going a little bit off script here. So what are the implications for individual investors? Are individual investors sort of able to navigate that rotational aspect of the market, or are they better off just staying very broadly diversified and taking the good with the bad?
Well, broad diversification is always a key, but in terms of the question around how can individual investors navigate it, or should they, I think you have to throw into the mix of that question, try to anticipate it in advance and position around that, or navigate by adjusting as these rotations are happening via disciplines like rebalancing, which that's very different than trying to guess what's the next leadership shift going to be, what sector or what factor or what style index is going to be in vogue for the next few weeks. That's a fool's errand. But for investors that can handle it in terms of what type of account it is, the implications of turnover, all of those obvious issues, you can maybe step up the pace of rebalancing, take advantage of the big swings by maybe trimming a bit more frequently where you're given strength and adding to where there's weakness, and navigate by adopting disciplines that sort of react to what's going on as opposed to try to forecast what is going to happen.
Great. One more question on sort of where the market is right now. I know one chart I've seen you present many times is this cycle of investor sentiment. So I do hear the current period that we're in compared to the dot-com bubble of 1999 and 2000 fairly frequently, and I'm curious if you think that's an apt comparison, what the important differences are, and where we are in that investor sentiment cycle.
So I think there are similarities between that environment and now on some traditional measures of investor sentiment and froth, like the put-call ratio, or maybe at times American Association of Individual Investors, other behavioral measures of investor sentiment, like household exposure to equities being now around 62%, which is similar to the high it hit in 2000. But I think there are important differences too. And two key differences are, number one, a lot of the speculative froth that has really become rampant at times this year has been concentrated outside of the traditional averages in some of the non-traditional pockets of the market, whether it's the meme stocks or SPACs or non-profitable tech or bankruptcy stocks, or, I'd throw crypto into the mix there. Whereas in the lead into the peak in 2000, the speculative froth was heavily concentrated in the big leadership names in the benchmark indexes. In addition, what was happening as prices were going up exponentially into the peak, earnings were also going up just at a lesser pace. And that's why valuations got stretched. We got to very stretched valuations at the end of the last year, but it was because of the collapse in earnings last year. Now we've had this massive rebound in earnings, which very quickly had the effect of bringing valuations down, not into anything resembling cheap territory, but at least we've had the denominator in the PE equation doing a lot more of the heavy lifting. So I think we've had a bunch of micro bubbles in the market, many of those non-traditional segments that in some cases popped in spectacular fashion, even if some of them sort of got inflated again. But I'm not sure I would necessarily apply that term, at least as it relates to what we think of as the bubble bursting in 2000, to any of the broad indexes, at least not at this point.
Yeah, and I would agree with that. Anecdotally, I don't feel like, whether it's, investment clubs or people day trading, I don't feel the same sort of level of froth that we did, 20, 21 years ago. But I've certainly seen, we've all seen those pockets of, as you said, sort of the meme stocks and that crypto and other areas where there does seem to be some what's the old term, irrational exuberance, maybe. Mm-hmm. So. All right, Kathy, I've let you rest up for what's one of maybe the heart of the presentation today, and something that I think is weighing very, very heavily on everybody's minds, which is the dreaded I word, inflation. When we, just as a little background, when we started planning this presentation, we were going to spend a lot of time on whether inflation is transitory or not, and I'm sure some folks in our audience saw that yesterday, even the Fed chair decided that maybe it's time to retire the word transitory. So, I think we've heard more about inflation in the last 6 to 12 months than any period I can recall in my career. Some people have raised concerns that we're in for another era of stagflation, high inflation combined with sluggish economic growth like we saw in the mid-70s. Can you give us some background on what's driving inflation today and where you stand on, maybe we'll change the terminology a little bit, how persistent this inflation is likely to be?
Sure. And I think I'm probably, one of the few on here who's old enough to remember the 1970s pretty well. And my recollection of that is that we had much more sluggish growth, much more challenge in terms of economic growth. If we think about stagflation today, there's not a lot of stagnation in the economy. We actually have a pretty robust economy, growing at a pretty rapid rate. Some of that obviously will start to ease up a bit. We're coming off of that recovery period, but we have much stronger economic growth right now. What we do have that's similar to the 70s is inflation. I would say the origins of it are significantly different, and I do think that we're probably poised to see inflation come down over the next 6 to 12 months. When you think back to the 70s, a couple of the factors that drove it were in 1971, we severed our last ties to the gold standard, and that allowed the dollar to fall pretty significantly, and that boosted inflation. We had just a lot of policy missteps with regards to how inflation was handled. If you remember, wage and price controls, and then we had the various shocks, 2 oil shocks. We also had a much higher level of wage inflation because at the time, many more people were engaged in unions, and they got automatic cost of living increases. That's much less true today. Now we are starting to see wages rise, but in many ways, wages have lagged productivity for decades. So in some ways, we're just sort of catching up to wages being more in line with the productivity and the economic growth in the economy. So I'd say it's a very different kind of environment. It has echoes, but I'd say it's very different. What we are seeing on the horizon now is, obviously we've had strong inflation over the last 6 to 12 months coming out of recovery. Some of this has been supply chain issues. We just couldn't get the goods, and demand for goods was very, very strong. Think about the used cars, the computer chips for the auto sector. It was very intense for a while. We're starting to see that ease up. Just today, we got the index it's the manufacturing index came out, and they do a survey that really reflects a lot of different issues that manufacturers face. So not only is manufacturing still growing at a pretty healthy rate, but inventories, the ratio of new orders to inventories has evened out quite a bit. So for a while, new orders were far exceeding the inventory that was available to meet those orders. And now we're starting to see it come back to a much more normal level. And that's starting to tell us that at least that supply demand imbalance in the goods sector is evening out. We're also seeing a big drop in commodity prices. I'm surprised this hasn't made bigger news. Oil prices are down 30% from the recent highs. Wholesale gasoline prices are down. Now, I'm pretty sure at the pump, they're not down that much. That's pretty sticky. But when you start to see those things happening, what you see is those input costs starting to roll over. And that usually portends easier inflation pressures down the road. In addition to that, what we're also seeing is sort of the base, what we call the base effects, the comparison to a year ago, that will shift as we get into the new year. We had big increases relative to big declines. Now we should see maybe small increases relative to big increases, and that means we'll level off a bit in terms of the rate of change in inflation. Doesn't mean it's going to go away, but I doubt if it's going to run 5 or 6%. It's probably going to recede as we go out over the next couple of years as the economy rebalances. We have had higher labor costs, but even at that, what we're seeing is companies seem to be able to absorb those costs pretty handily. Corporate profits are still up, margins are still holding in there. So we may be seeing some stronger economic growth, but I'm not sure that we're going to see this sustained inflation over time. And the last point I'll make is, look, the Fed's going to tighten. And that tends to send the signal of slower growth and lower inflation on the horizon. And we're already starting to see that ever since the Fed, has been hinting over the last couple of months that they're going to withdraw some of the stimulus and start to tighten policy, we've started to see some of that inflation pressure when we look at the inflation expectations numbers starting to level off a bit. And of course, we had the confirmation from Fed Chair Powell that they've retired the word transitory, which was an unfortunate choice, I think, in the beginning, because it kind of put a time frame on it. And they were, clearly their timing was not good, whatever that meant. But I do think that we are not likely to see the 5 to 6% inflation that we've seen this year in 2022. It's probably going to recede. And I think in a couple of years, we're probably back in that 2 to 2.5% area. And keep in mind, the Fed can manufacture that if they want to. They can tighten policy to the point where they cause a recession if they want to. I don't think they want to by any means, but it can happen. So I think that the Fed's really more in the driver's seat than sometimes the financial press might give them credit for.
Just one quick piece of feedback. I guarantee you gas prices have not come down, because my daughter complains that they keep going up. She's 17 and she's continually asking for more gas money based on the price at the pump. So maybe one of these days.
Yeah.
One thing I think mystifies a lot of people, sometimes including myself, is the connection between inflation and the bond market. And maybe that's even more so in the 12 or 13 years that we've had, most recently, where the Fed has been an enormous player in the bond market. So I guess the question I have is, if financial markets are truly concerned about persistent ongoing inflation, wouldn't we see a significant bond market sell-off and higher yields materialize? Or do we just have so much distortion in the bond market because the Fed is buying $120 billion of bonds every month, that we're not able to see those signals clearly?
Well, I think it's a bit of a combination of things. So when the Fed does quantitative easing, when they buy bonds, what we've seen over the years is actually bond yields will tend to go up. Longer term bond yields have tended to go up when they do that, and then they come down when they stop. And the reason is the power of quantitative easing is in the signal, not in the actual execution. I think it was Fed Chair Bernanke who said the problem is it works better in real life than it does on paper. And so what it means is that by signaling that the Fed is very concerned about a sluggish economy, possibly deflation in the past, by signaling, hey, we're going to do everything we can to keep interest rates low to boost the economy, that has tended to actually raise expectations for economic growth if you look out a couple of years. When they pull back on that, the opposite happens. And that's where the bond market is very different, I think, in the way it's seeing the world than, say, some of the other markets or the equity market right now. So you see that yield curve flattening as the market anticipates shorter term rates going up, but that sends a signal that the Fed is tightening. Monetary conditions are going to get tighter. The cost of money is going to be higher. Loans are going to be more expensive for businesses. That may cause them to pare back a bit on investment. That may cause consumers to pull back in terms of, buying houses because mortgage rates are up, or buying cars because leasing rates are up, et cetera. And so when that signal gets transmitted to longer term bonds, they actually tend to not rise as much as short-term interest rates do. And I think that that's what we're witnessing right now is, the Fed has been a big player, but as we've seen them come in and go out of the market over the last 20 years or so, the actual market action has been sort of the opposite of what you would expect. And that's again, I keep using this word signal, but that's really the power of what they're doing. The other thing I'll say is, as the Fed pulls back, it doesn't mean rates can't go up. We do think they will go up, and we think that's because the economy is doing better, and they're still very low relative to where the economy is. But I'm not so worried about this imbalance of the Fed pulling back, because the Treasury is also going to be issuing a lot less bonds next year. So our deficit's falling. We've had this big explosion in the deficit because of the recovery packages that we put in place for the pandemic. Now the Treasury is going to be issuing a lot less debt, and the Fed is not going to be buying, but that they sort of wash each other out. In fact, net issuance will decline next year. So I'm not worried about that being a big driver on the supply-demand balance in the bond market.
That's very helpful. Thank you. I want to ask a couple questions about sort of inflation and its impact on how investors might think about their portfolios. So obviously, there's one asset class in particular that's directly tied to inflation rates, and that's Treasury inflation protected securities, or TIPS. What would need to happen for TIPS to be a good investment from this point going forward? I know that they've had a pretty good run in the last year and a half.
Yeah, actually, TIPS have done quite well over the last few years. And that's because obviously they're indexed to CPI, and CPI has been going up, and investors have been looking to TIPS as one way to offset inflation risks in their portfolios, and they work quite well. So they've been one of the stronger performing asset classes. I'd say the problem right now is that current valuations are challenging. So the yields are low or even negative. Inflation expectations that are sort of embedded in the pricing right now is pretty high. So if we look at, say, 2-year, 5-year TIPS, they're implying inflation has to average close to 2 3/4, 3% over the next couple of years. That may happen, but remember, you need to have a 6% year, and then you need another year that goes up and another year that goes up to keep that inflation rate climbing at a fairly rapid pace. All we need to do is come in at a year that's 2%, and you might be mispriced in the TIPS market right now. So, and also their bonds. So if interest rates go up, those yields are going to go up, and the price is going to go down just like any other bond. Our view is that they can be a really good tool if you're concerned over the long run about accelerating inflation. It's still a good hedge because it's tied to that overall CPI. But you need to be kind of realistic here in terms of what your expected return would be. And that means that the boost that we've seen probably won't be the same, may outperform nominal treasuries going forward, but it may not be a real great return. So, we're kind of more neutral now than we were before. We still think it's a good tool, but we were pretty big advocates for a long time. And now, it's looking less attractive because a lot of the pricing has already been, discounting much higher inflation.
I guess that raises the question for me has that same dynamic taken place in other parts of the financial markets that might traditionally have been thought of as good inflation hedges? So maybe real estate or REITs, certain parts of the equity market. And I'd ask both of you to weigh in on this one. Are there other asset classes that do offer effective inflation protection? And is there a danger for investors in too aggressively trying to inflation-proof their portfolio? I don't know who wants to go first.
Yeah, I'll take a first shot, and then Liz Ann can weigh in on a lot of the other the equity side of it. So in the bond market, there's not a lot of great ways. You typically can outperform inflation or keep up better with inflation if you have more of a credit focus in the portfolio, simply because the coupon payments are higher, and they're more, when I'm talking about investment grade corporate bonds or junk bonds, high yield bonds, they'll tend to do a little bit better in an inflationary environment simply because they have higher coupon payments to protect you from a rise in rates, and they tend to be much more correlated with the stock market and the overall economy. So performance can be okay, but it's not a panacea for inflation. REITs, MLPs, those are more, they can outperform at times, but again, they're not perfect hedges. So a lot of the things that people talk about as hedging inflation, really what they're talking about is, have they historically outperformed or kept pace with inflation? There's a big difference between what a hedge is and what performance is. And I think that's a mistake a lot of people make in their portfolios, just a hedge actually means that you have an equal and opposite reaction to whatever you're trying to manage. That can happen with tips, but it can't necessarily happen with a lot of other asset classes. So I think you need to think about what is the risk side versus what the reward side potentially is. You can maybe keep pace with inflation, but you're not necessarily hedging it. And so there's an imperfection there, and you can get a lot of volatility in returns.
Yeah, I think Kathy makes a very good point about hedging and what that actually means. And it's more than just semantics. And Kathy, I think you're right. When I get the question often and that term is used, I think sometimes it's being asked by somebody who is actually looking for what we think of as a traditional hedge. But most of the time is there any consistency to asset classes or sub-asset classes that outperform inflation? And even the answer to that is pretty mixed. There's no one perfect asset class or sub-asset class or sector that is always the go-to when you have a rising inflation environment. In fact, even just broadly equities, if you go back through the modern history of the S&P 500, since the 50s when it became the 500 stocks as we know it now, and you just simply break the environment, that entire period, into rising inflation using the CPI or falling inflation, and then look at equity market performance again using the S&P, no surprise, very strong performance when inflation is falling, much weaker performance when inflation is rising. However, if you add another ingredient into the mix and actually look at GDP growth and break it into quartiles, so sort of 4 zones of GDP growth, maybe no surprise, when you're in the worst zone of GDP growth and inflation is rising, that's when you see an even bigger difference in terms of weakness in the equity market. But if you go out to the highest quartile in GDP performance, not only does that spread narrow, the stock market is done better when inflation is rising if growth is also strong. And that goes back to a few of the things that Kathy said in the early part of the discussion about inflation. And it's a combination not just of the backdrop of inflation, but what the background economic conditions are as to whether it's sort of a toxic brew for equities or not a bad brew for equities. If you think much longer term and you do a simple decade by decade analysis, the only asset class, or maybe you could call it a sub-asset class, that has outperformed inflation every decade. And again, we're talking about 10-year spans of time, not on a month-to-month, quarter-to-quarter basis. It's US small cap stocks. And you have to use proxies for small caps pre the late 70s because that was the inception of Russell. So it's a little nefarious in terms of the background calculation. And that by no means suggests, well, we're in rising inflation, back up the truck and load up on small caps and you'll do well, because they've actually not been doing well in this environment. Energy has been the most consistent outperformer at the sector level. But if you get a reversal in oil prices like we've seen, then you can see a really, really hard hit to a sector like energy, even if the overall inflation environment is still fairly hot. So there's a lot of ingredients that go into the mix in terms of what tends to do well. Even gold, which is kind of seen as this classic inflation protectant, more so than a hedge, is not a consistent outperformer of inflation. And in today's day and age, anyone that might be looking for what might have historically looked at gold to represent that counter to inflation or the hedge, lowercase h and air quotes, might have found another home in cryptocurrencies. So there's that added kind of wrinkle in the mix in terms of maybe some of the traditional places investors have gone to attempt to hide from inflation risk.
So Liz Ann, just a quick follow-up. So some of the areas that you sort of rattled off, I mean, you said small caps have not done particularly well, even though they've demonstrated historically that at least over 10-year timeframes, they can outperform inflation. In other areas that you talked about, are you seeing like tips that those look like they might be a little bit rich or a little bit overbought?
Well, I think the way investors probably should approach this in terms of trying to kind of pick the right areas or the right stocks in an ongoing inflationary environment is less about sectors or style and more about what characteristics, what are the factors that tend to set companies or maybe sub-industries apart in a heightened inflation environment. Some of them are obvious, like pricing power. In a more constrained profit margin environment, prospectively, a more constrained overall earnings growth environment, assuming profit margins start to take it a bit on the chin, you can look for companies that have that sort of steady increase in expectations around profit margins or strong and rising earnings revisions. Strong free cash flow, I think, comes into the mix. So I think more of a factor-based approach, even just broadly, not just as it ties to how to kind of play the inflation environment, I think it makes a lot more sense in this environment as opposed to trying to pick a sector or two or a style box or two based on macro conditions.
Got it. I just want to remind attendees, if you have any questions, please click on the Q&A button down at the bottom of your screen and send those in. We will be starting the Q&A in around 20 minutes or so from now. So I know we've already talked a little bit about we've touched on the Fed and monetary policy, but I think there's still a couple angles that we'd like to explore. Until a couple weeks ago, it was still unknown whether President Biden would renominate Fed Chair Jerome Powell for another term. He did go ahead and do that, and then he also nominated Lael Brainerd as vice chair. Kathy, how did you view those personnel moves or endorsements, maybe in Fed Chair Powell's case? And do you anticipate, as a result, there will be any significant sort of policy changes, communication changes from the Fed in the next year or so?
Well, first of all, it was long overdue. We were all sitting around waiting for it for a long time, so it's kind of a relief when it finally happened. But I think that part of the goal on the Biden administration was to do no harm in terms of shaking up the Fed at this stage of the game, because we're in the midst of this very volatile economic change, and to change horses midstream would maybe create more volatility. I think there are also concerns about confirmation. So it was apparent that Powell had support on both the Republican side and the Democratic side in the Senate for making it an easier confirmation than Brainerd. Powell is a Republican, has a strong business background. He's an attorney, not an economist, but he had support on both sides of the aisle. And I think the administration really didn't want to pick a fight right now. They've had enough fights right now with Congress that they're pursuing. That this was one they didn't really want to pursue. Lael Brainerd, on the other hand, is a top flight economist. She has international experience. She has led the study of having a central bank digital currency. She's got some regulatory views. So she is, as a vice chair, that's really kind of the economic and monetary policy setter at the Fed. She'll be replacing Richard Clarida, who had very similar credentials. And so I think that in many ways, it's trying to send a reassuring message to the markets and to the public that, we're going to stay the course here. We've got good people in charge. They're going to continue to do what they need to do. And then we saw Powell finally publicly pivot towards the tightening after his renomination was made clear. I think there was a little bit of that going on as well, that he didn't want to say too much until he knew whether he was going to be renominated. There's still some open seats at the Fed, so there's still some question marks there. I think there'll be 2 potential new seats, and then at the regional bank president level, there's a couple of open seats in Dallas, and so there'll be some changes. I don't think there'll be huge changes. I think the regulation of banks will be tougher than it was with this administration than it was with the last. But I don't know that that's going to make a huge amount of difference because the banks are well capitalized. You know, we're well past the financial crisis. So substantively, maybe not so much. So overall, I think it's more of a, we know kind of now where the Fed wants to go. They've gone from this very easy policy. They want to go to a tighter policy. Probably that gradual approach will be pursued to the extent that the market allows them to pursue it. If we get a big market rout based on inflation again, and they may have to move out the timeline, but I think we know where they want to go.
So I think that gets us to, it's a good segue to kind of the next question, which is a little bit more specificity around, you know, the Fed tightening their policy. So, you know, since COVID hit in March of 2020, the Fed has provided an enormous amount of monetary stimulus to the economy, both in terms of monthly purchases of Treasury bonds and mortgage bonds, I believe $120 billion a month. And also taking interest rates, the Fed funds rate all the way down to zero. In the last month, I think it was just about a month ago, they began tapering the bond purchases by $15 billion a month. And it sounds like Powell a couple of days ago to Congress indicated that they will at least start talking about accelerating that schedule. What has changed in there? A couple of questions. What has sort of changed in Powell's mind? What new evidence has he seen, do you think, that is making him sort of take up something that seemed like it was maybe not carved in stone, but a pretty solid plan with a fair amount of consensus around it? And how do you anticipate, what do you sort of see as the likely timeline for both the tapering to wrap up, and then a real consideration of increasing the Fed funds rate?
Yeah, we expect that they'll double the pace of tapering, meaning instead of, you know, right now it's 15 billion a month they're pairing, it'll be 30 billion. Based on that, we think they'll be done at the end of the first quarter sometime. And then and what's changed really is the economy and inflation. So the economy has been far more robust in terms of this recovery, I think, than the Fed ever anticipated. So we came out of the COVID shutdown much stronger than and much faster than anyone anticipated. So they really had to change their expectations about the economy. And then, of course, the result was, because demand picked up so fast, inflation flared up much more than expected. And they had been, I think, a lot of the transitory argument was based on the idea that supply chain problems were going to be very short-lived. It turned out that they have had much longer lives than expected. So all those things have changed. And frankly, the bond purchases haven't been doing much good anyway, right? The market has flooded with liquidity. The Fed doesn't have to provide more liquidity. They haven't for quite some time. And I think there's a realization that, hey, it's not doing any good. It could be doing some harm. Let's just get out of the way and stop doing this. So net, I think that those are sort of the driving factors that they looked at. We expect at least one rate hike in the second half of 2022. I know the market is pricing in a more aggressive pace of rate hikes than we are at this stage of the game, but we are also, I think, a little bit more inclined to say that we think the inflation numbers are going to start to get better faster than the market anticipates, and that's going to give the Fed some room. You know, I often hear, you know, clients especially, but everyone's like, well, I want bond yields to be higher, right? I want a positive return after inflation on my bonds. They're so low. Why don't they just raise rates? But keep in mind, you know, kind of watch what you hope for, because that really, you know, reprices a lot of other securities and in the market. So I don't think the Fed wants to go to 0 to 2% overnight. They want the market to adjust to be ready for this, and they're okay with lagging it a little bit in order to give the market time to change course and to adjust to that. So, and then, you know, final thing, we still have zero interest rates or negative interest rates in much of the world. So we already have the dollar is very strong. If we move really fast to raise rates, and Europe has still got negative rates, Japan has still got flat zero rates, The UK, who knows what they're doing? Every day they change their minds. But the point is, this will send the dollar up, and that will slow the economy and cool inflation in and of itself. So it's something to keep in mind. It's not just what US policy is. US policy kind of sets the tone for the rest of the world. The Fed is the central bank to the world in many ways. And if we raise rates very quickly, sends a dollar up, it also hurts emerging market economies pretty severely. It can have ramifications beyond just, the United States borders. So things to keep in mind, things that the Fed considers when they talk about changing policy, which is why they want to take a pretty gradual approach. Take a step, evaluate, take another step, evaluate. And that's what I expect over the next year or two.
Thanks. A lot of great material there. Your next to last point is a really interesting one to me, which is this idea that all these financial markets are interconnected, and if someone waved a magic wand and suddenly made a 10-year Treasury yielding 4 or 5%, I probably know quite a few people who would sell off some of their stocks and other assets to pile into so-called risk-free assets at 5%. And that would have an impact on those other markets. So I think that's a great point. And I do want to, maybe we'll move forward a little bit into some specific portfolio concerns that I think we hear about quite often. And one we've just talked about, but I think I want to explore it a little bit further. We've had a low interest rate environment now for, essentially a decade, maybe longer now. In that 10-year period, on just a couple of occasions, I had to look back at a chart, but early 2014, late 2018, you saw the 10-year Treasury yield touch 3%. Both times it retreated pretty quickly from that level. Today we're back down below 1.5% on a 10-year Treasury. I think the question a lot of investors, a lot of our clients have is, if you have inflation at 5+%, why should investors still have a significant allocation to high quality bonds with such low yields? Aren't they guaranteed to lose money?
Yeah, I mean, it's a great question. It's one, obviously, that comes up all the time. So when we talk about having an allocation to fixed income, we talk about the reasons are, capital preservation. This is high quality fixed income, capital preservation, earning some income, and diversification from other assets, particularly from stocks. And those reasons don't change with the level of interest rates. Now, you can obviously tactically change your portfolio when, we've been suggesting keeping duration fairly low for a while because we have anticipated interest rates moving up and because real yields are negative. And we think that that gap will close with inflation coming down and nominal yields going up. So we've been careful to try to stay, in not really long-term bonds that are very sensitive to rising interest rates. You can pivot into credit-oriented bonds, but as you go down the credit curve into high yield, junk bonds, and bank loans and other areas, you can certainly pick up more yield and keep better pace with inflation, but you're going to take more credit risk and you're going to skew your portfolio towards more towards the equity side risk. So when you need that diversification, if you do that, you're not going to get it. We just saw recently when the stock market sold off, the bonds rallied, and that's the kind of relationship that you want to see when you have a balanced portfolio. So, the diversification, the capital preservation, and earning some income, all part of it. And there's ways to maneuver to kind of benefit from changes in the yield curve. We've tended to like bond ladders and, kind of moving, taking advantage of a rise in rates over time without allocating to a bunch of 30-year bonds at low yields. So there are ways that can be done to, to mitigate some of the risks of rising rates. But if you eliminate high quality fixed income from a portfolio, you better be ready for the volatility that comes. So we just went back and looked at a 60-40 portfolio returns over the years. And what we saw was, it's a much maligned now strategy with a lot of people warning that bonds can't provide that sort of offset to stocks. And we went back and we looked and, you're still getting a risk reduction of about, a factor of half. So the risk profile of your portfolio is about half what it is if you're all equities. And there's value in that. We all know that when we're planning, there are times we need access to our money. There are times when we don't want to see our money go down, our values go down a lot. And we don't want to have to sell in those environments. So a gradual approach to adding income over time if rates go up, I think is the sensible approach. And some allocation, it's, we always think it's kind of an individual thing, but some allocation to high quality fixed income still works when you hit rough waters.
Yeah, I mean, I think what I'm hearing, and I think it echoes with a lot of what we've told clients over the last few years, is that there's no silver bullet. And as painful as it may be to experience, we all wish we could, magically be in a world where, high quality bonds paid 5%, but that's not the world we're currently living in. And the bonds do still serve a function in the portfolio to mitigate the portfolio risk when you have tough times in risk assets. So I think, maybe one question to follow on that would be, and you touched on corporate credit, but how does corporate credit sort of look, today relative to other points in the past? Does it look rich? Are there opportunities there to maybe add a little bit of income exposure there, or income generating opportunity there to offset the really low yields in treasuries and agencies?
Yeah, we have sort of a neutral view on it right now. So we think the underlying fundamentals for corporate bonds are really good. Strong earnings growth. Corporations are by and large have a lot of liquid assets on their balance sheets. Many have extended the duration of their debt out so that they've locked in low interest rates on their borrowings. And the economy is healthy. So all those things, just as they're good for the stock market, they're good for corporate bonds. We're not really worried about investment grade companies having difficulty paying their debts, delivering that income. We're not looking for downgrades, significant downgrades. I guess if we were to hit, another lockdown situation, you could see some of the sectors like airlines, hotels, et cetera, have a lot of difficulty. But by and large, the outlook for the credit profile is good. So we think that's fine. The downside is that, the spread, the extra yield you get is pretty low relative to where, the long-term average. It's not at the lows, but it's not huge. So you can pick up that. And the other thing is that the duration is fairly long these days in the investment grade market. But we think it's a good solid asset class to have some allocation to. When you go further down, you go into junk bonds, you go into bank loans. The junk bond market has been floundering recently. So you get those higher yields. If you want 4 or 5% yields, that's where you're going to go. But you're going to see a lot more volatility. And we've seen that recently because of the jitters in the stock market. So much more highly correlated with stocks. And, these are companies, if we hit a pothole in the economy, that are going to have a tougher time paying their bills. So you don't want to, in our view, you don't want a huge allocation, particularly because you're not getting paid a lot right now relative to treasuries to do that. So it's always sort of like buyer beware. If you want those higher yields, you can get them. But you have to like lock in and say, okay, I'm committed to this for a period of time to benefit from it. Bank loans, that's another area. These are essentially junk credits, but they have very short durations, which makes them less interest rate sensitive, and often floating rate coupons. They reset often, so they've been pretty popular. We kind of think that if you have the risk appetite and capacity to be in high yield, you might want to look at some of the bank loans just because you can offset some of the interest rate risk there. Similar credit profile, but a little bit less interest rate risk. So there's ways to slice it and dice it, but as you say, there's no magic bullet. There's no, if I could produce that 5% tax exempt risk-free bond, I would be a very popular person right now.
Well, and it makes me think back to, we talked earlier about differences between now and the environment, say 20 years ago when the dot-com bubble was going. I mean, we're in California, California state muni bonds at the time were probably yielding between 4 and 5% tax-free. And it's like, I know a lot of people on this call who would probably love to have that opportunity available to them today, but that's not the world we live in. I do want to, again, I'm going to go a little bit off script here. When we get into January, one thing we do on our investment committee here at Dowling Yahnke is, sharpen our pencil and put together capital market assumptions. And obviously, there are a lot of investment banks and others and asset managers who do the same thing. In a world where the 10-year Treasury is yielding 1.5%, I'm interested in both of your takes on, what can investors sort of reasonably expect from, say, a 60-40 portfolio over a 10, 15, 20-year time horizon, and knowing that it'll vary every year, but sort of just in terms of an average annual return.
Well, Liz Ann, I'll jump in. We do have capital market estimates that our quantitative research group does. I don't have the exact numbers off the top of my head, but from the fixed income market, what they tend to look at is simply where is the market pricing returns over the next 10 years, 5 to 10 years. And the market's pricing on the fixed income side, something in the order of 2 to 2.5%. So from a fixed income point of view, that's probably the best estimate we can give you. Now that can change if the interest rate outlook changes significantly from here. I tend to think it might be a little bit higher going forward, just because I think we are going to get more of a lift in rates over time. But on the fixed income side, that's probably the most, the easiest sort of intuitive way to look at it. And it basically is a quantitative way to look at it as well.
Yeah, on the equity side, and Kathy, you may have looked at our assumptions more recently than I to know what is embedded in those assumptions on the equity side, but most that I've seen broadly in the industry are in the low to mid single digit range. But one thing that I look at in terms of not 10-year forecast of equity returns, but what history has suggested based on the level of exposure to equities that households have, that has had a pretty tight connection to subsequent 10-year average returns. And if you break households' exposure to equities into quintiles back in the post-World War II era, and you can actually get data back to the inception 1928 era of the S&P 500, maybe no surprise when exposure to equities is in the lowest quintile, subsequent 10-year returns have been in the highest zone. And it's a perfect stair-step pattern in the opposite direction. As you move to the highest quintile of household exposure to equities, the subsequent 10-year returns go not into negative territory, but they're the lowest among those sort of 5 categories. We are in the top quintile right now. We're at the high end of the top quintile, at least based on history. As I mentioned, looking at about 62% exposure to equities, which is almost dead even with the prior peak, which was in 2000. And based on history, again, this is never a perfect guide for what's going to happen in the future. The subsequent 10-year returns were around 2.8% for equities using the S&P as a benchmark. Now, the problem with the equity market, of course, is it's quite a bit more volatile typically than the bond market. So to say, even if there's some accuracy around, call it, let's round to a 3% 10-year return, that by no means means that every year for the next 10 years, you're going to bank 3% in equities. So we're going to be all over the map, even if ultimately we settle down to that. But I think the overarching message is to curb your enthusiasm about the ability for the equity market to maintain the kind of pace of gains that certainly pre-existed the pandemic, and now in the aftermath of a very short-lived bear market, be really careful about extrapolating the kind of equity gains we've seen off the March 2020 lows.
That's a sort of dismal forecast.
There'll be highs and lows, though.
I think that what I think that the message is maybe not quite so downbeat. It's more that where you start matters, right? The starting valuation does matter, and that's something to keep in mind. But there's going to be ups and downs, but I think most estimates I've seen on the street are in, similar sort of in that modest range compared to where we've been.
Well, and I said dismal sort of jokingly, because I think people also do need to account for the fact that their returns have probably been above average for the last handful of years, even with the COVID sell-off, right? So, when you have a period of elevated returns, you may end up having to pay the piper a little bit going forward. So I want to weave in, we are getting a few questions, and I think I still have a couple of prepared ones, but I want to weave in a couple of these. The first one relates to, Kathy, you mentioned it a little bit, international bonds. The question is, while the capital preservation diversification of bonds still remain, given the environment in the EU, UK, Japan, et cetera, as was discussed, is there still a case for international bonds? I think the implication being, with yields there being even lower than they are in the US.
Yeah, it's been a tough space. We have not been particularly favorable towards international bonds for a while now, for two obvious reasons. One is yields outside the US have been very low on a relative basis, which kind of puts you behind the 8 ball if you're a US dollar investor, right? You're giving up interest income in order to hold those bonds. And then secondly, the US economy has been outperforming the rest of the world, and that's given us a significant boost to the currency. So when I look back through history tells us that international bonds are good for diversification. And they have performed well when the US stock market has gone down relative to other markets. That's usually a currency-driven aspect to it. So I hesitate to say, no, it's not a good place to be invested, but we haven't had any enthusiasm for it for a while. If things start to change and it looks like we're going to see a drop in the dollar, and it looks like we're going to see a drop in US assets relative to the rest of the world, then it might be worth a look. Some small allocation just for diversification can make sense, but not really crazy about it. Right now, emerging markets, a little different story. You can be in and out tactically in that asset class because you do get much higher yields. But right now, we're not favorably inclined, again, because we have tightening monetary policy in the US, a rising dollar, and a volatile environment are not good environments for emerging markets.
Let's stick for a second with international, but flip over to the international equity markets. Many investors have grown somewhat weary of seeing their international stocks chronically underperform their US equity allocation. Liz Ann, does global diversification still make sense? Are there particular areas within foreign markets that you're particularly bullish or bearish on?
So we do think it makes sense. Our bias right now outside of the US in terms of equities is significantly more on the developed international side than on the emerging market side. And absolute performance this year so far has actually been quite healthy. It's just still paled in comparison to the S&P. I think the risk that investors take is that they either put too much into the US equity market or everything into a US bias market at a point where we've gone many, many years of outperformance, and there will be a reversion to the mean at some point. You do tend to go through long cycles of US dominance versus international dominance. The most recent has been more biased on the emerging market side. We think more of a bias on the developed international side, but also it's been driven by lack of rebalancing. So part of the reason why we got to the 62% household exposure to US equities was the lack of rebalancing. So as your exposure, as you get that outperformance, which has been fairly consistent, it becomes a bigger and bigger weight in your portfolio. And it doesn't necessitate some moment in time timing decision. It just should be part of that disciplined rebalancing process not to try to time the perfect potential turn, but to make sure that when that does happen, all your eggs aren't in the U.S. large cap equity basket, which in the absence of rebalancing for many investors, that is the case. You do tend to, when you come out of what we call a dual cycle, where you have a major bear market, it's in conjunction with a recession, that typically does usher in a new phase of broad leadership shifts. That didn't happen precisely this time, and it may be the unique nature of what was, yes, a dual cycle, a recession and a bear market, but so unique in terms of what the drivers were, how short-lived the bear market was, how short-lived the recession was. It was almost like what we experienced was a bit more wartime than it was the end of one true economic and market cycle and the relaunching of a brand new economic and market cycle. So that could help explain why that shift, which often occurs, didn't happen. But again, international equities have actually given you healthy positive returns. It's just still been below the S&P if you're using that as the proxy for US equities.
And Liz Ann, ballpark, in terms of PE multiples at the very broad market level, what does the US look like relative to other developed markets?
Well, so on a forward PE basis, you're looking at about 21, and much of the rest of the world, looking at it broadly in broad regional areas, is lower than that. That valuation discount is significant. But what's always worth pointing out, especially if you go to the country level and you do comparisons, be careful because you're not really comparing apples to apples. This is one of the things Jeff Kleintop talks about a lot. It to some degree, the multiple and the range it tends to be in is somewhat driven by whatever sector is a dominant driver of your economy. In the United States, we have a much bigger driver of our economy related to innovation and technology, which naturally tends to afford a higher multiple. Versus if you are, a country like Australia, where it's resources and mining, that tends to have a much lower multiple. And the list can go on and on. You can point to other areas, Germany being big auto production. So you have to look at valuation relative to the sector bias within the economy relative to its own history, not just a simplistic spreadsheet of let's look at forward PEs across countries and then just pick the cheapest. It's the underlying structure of the economy that comes into play. But even taking that into consideration, you're looking at a pretty decent valuation discount. The one thing we would say from an overarching sense is valuation tells you absolutely nothing about what any market is going to do, say, in the next year. It is a horrifically bad market timing tool. To Kathy's point about its sort of 10-year returns is a function of what your start point is, whether it's a valuation related start point or an exposure to equities start point. So it is a more valuable tool when looking out, say, 10 years to judge whether you're going to have an above or below average prospective return. But to say, I'm going to get out of stocks because the market is expensive, you might be right, but it's a terrible reason to make a decision like that.
Yep. We had a question on China. Could you talk a little about the change in the Chinese government's regulatory crackdown on tech and where this could lead for the Chinese market as a whole?
Yeah, so of course, China is broadly, and it's the biggest player in the emerging markets index, and that has not been the area of focus for us with this bias toward international. As I said, it's been more on the developed international side, but specific to China, I think there's a lot more bigger picture and secular things going on in China that sometimes get lost in the headlines around the regulatory crackdown, whether it's of the education space or certain components of the technology space. I think it's tied into not only just the shifting tides in terms of the economic backdrop in China, but their shift to this common prosperity view, and also this longer term attempt to wean themselves off this connectivity to the United States and the US dollar. And that ties into not only decisions they've made in terms of regulatory crackdown, decisions they've made to not step in and rescue big players, whether it's Evergrande in the same degree that they might have 5 or 10 years ago, whether it's a reason why they banned Bitcoin as they want to try to establish their own currency as more of a global player, whether it's decisions they've made in terms of energy policy, trying to rein in energy consumption so they lessen their dependence on the United States, and they developed connectivity with other regional players. So I think it's part and parcel of a much bigger story going on in China. And admittedly, the allowance that the government has in having the economy be at a slower rate of growth, trying to sort of adapt to demographic changes. The fact that the latest census data showed the population story as being much more negative than was originally thought to be the case. The fact that they have largely moved people from the rural areas to the developed areas, that they want to move away from just being the global provider of low-cost widgets. So these are really big shifts, and it has had implications for the Chinese equity market. And we think there is a possibility, given that you tend to see much bigger swings in something like the Shanghai Composite, much greater frequency of 10% corrections, of 20%, mini bear markets. So you have to be mindful of those swings, and there are tactical opportunities if you get to the sort of bottom end of one of these bigger swings that you tend to see in the US market. But at this point, it would probably be something more appropriate for more trading oriented folks, as opposed to thinking of China in terms of a long-term investment.
Yeah, it's interesting. I've started to see a trend of asset managers that are rolling out emerging markets funds ex-China, which is, you didn't see that as recently as a year or two ago, but I think it's very, very tied to this kind of common prosperity push in China. Okay, I think we have time for maybe 2 more, and maybe we can try to keep these quick. I'll put this first one to each of you. What do you see as the biggest risk to the market, and you can define market any way you want, in 2022? Kathy, you want to go first?
Sure. I guess, well, beyond the obvious, pandemic is still with us and hasn't gone away, and still is a risk to all the markets. But I would say that it is that we've had a high level of complacency, and in terms of the bond market in pricing, particularly on the credit side, not enough cushion, not enough risk premium has been put into the market. So I'm worried that if we get everybody's hopes and dreams satisfied that the Fed raises rates, you may be not benefiting as much as you think you're going to. And I want to add, I did look up our capital markets estimates for 10-year estimates for a moderate portfolio. It's about 5.5%. That compares to a long-term average of about 9.5%.
I'll take the 5.5. Sign me up.
And
can I get that every year?
Yes,
probably not.
No volatility.
Yeah, no volatility.
And an aggressive portfolio, we have 6.4. That compares to a long-term average of 10.3. So kind of that a more modest, as Liz Ann said, kind of single-digit returns.
And I'll actually kind of tack on to Kathy's perspective with regard to biggest risks. And it does tie into this shift in monetary policy toward a tighter environment. That in general, I think, should always be considered a risk when you get to where we are in the economic cycle, because monetary policy getting tighter has been the cause of many renewed recession or bear market. So we're not in uncharted territory here with that shift in monetary policy. But to Kathy's point about the credit markets, there's been heightened focus on the Treasury market, and we have seen leadership shifts and corrective phases in the equity market, especially this year, tied to the move in the 10-year. But the calm that has persisted for the most part in the credit markets, in credit spreads, even as you go out the risk spectrum, were we to see some sort of eruption there, there's always connectivity between what's happening in the credit markets and what happens in the equity markets. And you often get sort of that warning shot across the bow within the credit markets. And sometimes equity investors either aren't aware of that connectivity or choose to ignore it. I would be very concerned if we started to see a bit of an eruption in the credit markets and a faster widening out in spreads. I think that would be decidedly a negative environment for the equity market, certainly in terms of volatility.
Great. I've got one more. I think you both were hoping that you could dodge this one, but I'm sure you've heard it before. So should all, and I'll let either of you take this. I think Kathy, you may have a response for it. Should all investors allocate some portion of their portfolio to cryptocurrency in general or Bitcoin specifically? Why or why not?
Well, the answer is no, not all investors should ever do anything. So, and particularly,
I made that one too easy for you.
Yeah, but you know, and we do cover, in my group, we cover derivatives and we cover crypto because, well, frankly, we don't know where else to put it. So we ended up with it. But, you know, it's highly speculative. It's highly volatile. There's a lot of issues that are untested around it in terms of security and really it's correlate, you know, it's being promoted as an inflation hedge that hasn't worked so far. It's being promoted as this, you know, we don't really know. It's a very new asset class. It's very speculative. It's very volatile. So, you know, clearly though, done great. A lot of people have made tons of money in it and people are interested in investing. So our attitude is if you want to allocate a small portion of your extra money to crypto, do it in a fairly liquid one where you can find a certain amount of a level of security at least, because there's so many different versions of it out there and exchanges now cropping up. But you know, it's something that's so untested and so unknown, and you can't. I think it's not wise to allocate too much. We're saying, you know, 1 or 2% of your portfolio if you really want to take the risk. Go ahead, just be mindful of the fact that anything is possible.
Liz Ann, anything to add?
Well, Kathy and I both say this all the time, and I was expecting her to say it, but there may be a misnomer in terms of currency on the end of crypto, because as we know what the definition of a currency means, none of them are that. They're not a currency. So also understand that when it comes to the definition of what is a currency as we know it now.
Great. Well, unfortunately, we're going to have to end it there. Kathy and Liz Ann, that was so much fun. I want to thank both of you for joining us and helping us make sense of the interesting times we're all living through. And to all of you who joined us today, thanks for tuning in. If we didn't get to your question, a member of our team will follow up with you directly. Please remember, you can always check out the insights page on our website, dywealth.com, for additional commentary on investment and financial planning issues. And from all of us at Dowling Yahnke, we wish you a very festive and safe holiday season. Take care.